When something goes wrong in the oil and gas industry, it's usually front page news. And with all the new approaches to exploration, extraction and refining energy sources, risk managers struggle to keep up with exposures. Catherine Duffy, an SVP with Excel Insurance in Bermuda, sat down with us during the IRMI Energy Conference to discuss the emerging risks in oil and gas.
The greatest threats I feel that are facing the energy industry stem from the decrease in oil prices at the moment, which is creating talent scarcity as well as talent retention issues. What is happening now is we're finding that some of the energy industry is getting rid of some of the employees, but we're being told that the ones that they're getting rid of are the ones that should not have been there in the first place. So they're countering our concerns and saying that what they're doing is appropriate at the moment. But what we are concerned about is what happens when the industry starts to take off again. Will there be a gap between those that can do and those that can't? We're also concerned about the shift from economic power to geopolitical power and what that means from a safety perspective for energy companies that are having to go to areas which may not be as friendly for them. Right now, the insurance industry is having to collaborate a lot more than we used to with other departments in order for us as underwriters to keep up with what is going on in the energy industry. Technology has taken the industry to levels we had not anticipated so quickly. So as a result, we're using the resources of our risk engineers to help us to figure out what it means for these companies to be drilling in ultra deep waters. We are enlisting the support of our legal departments so that they can look at where there are some legal implications for them to operate in less friendly countries, what that means for us from a sanctions perspective, from a legal perspective, legal climate. We're also collaborating with our claims department so that they could trend past losses to see if they can indicate to us where the future liabilities will lie. We have emerging risk departments that are constantly looking at where our clients are operating to see if there's something that we should be concerned about. Hydraulic fracking, for instance, crude by rail, are those issues that we should be looking at, and where will those trend? And basically, it's not one man for himself or one woman for herself, it's everyone having to work together. The latest trends we're seeing with risk transfer in the energy industry seem to be where companies are now looking at increasing their retentions so that they will have more money to buy more limits at the top. And by doing this, what they're doing is they're actually buying for catastrophe reasons. And in also doing that, they are saving money, because if they're buying at lower retentions, then what happens is you're spending more money for risks that you can actually trend out yourself, and you can find other alternatives. We're also finding that with the alternative capital that's coming into the market, that traditional insurance is now being siphoned off into sidecars where you can actually, you have more trendable data, leaving us room to look at the emerging risks that are coming up and potentially coming up with solutions for our clients. Risk managers can never buy enough insurance. The point about insurance is that it's to transfer risk from their balance sheets to someone else. So with what is happening in the industry, with technology changing, with people moving to new areas, there's never enough insurance. Could people have said that there was enough insurance for a Deepwater Horizon issue? No, there was not. So clients, even if you think you have the best risk management around, what you're insuring against is human error, and there's never a solution to human error.
For more of our coverage of the 2015 IRMI Energy Risk and Insurance Conference, visit the RIN TV On Demand Library.